a beautiful, massive, not as massive as silver, not as massive as the USD Korean won, but one of the biggest for crypto, which has a much shorter history of existence, set up a large macro upside HVF in gold ounces, and it's got a lot more to come. And actually, I'll shock some people. I see $25,000 to $35,000. Yes, you just heard me say that. And in an overperformance spike, potentially beyond 50, in an overperformance spike. What we can tell you is that 333 was likely be a localized high for a spell before going significantly higher beyond that. I suspect it still give us amazing technical trading opportunities once it's had a bit of a reaction and a little bit of churn. I think there'll be some talk. Silver still isn't hitting the mainstream media on a meaningful basis. We run triple digits. We're on the knocking side of the door of triple digits, and I call quadruple digits.
A massive technical structure is forming in the crypto markets, specifically a Hunt Volatility Funnel, HVF, priced in gold ounces, signaling a violent upside breakout. While 333 is identified as a likely localized high, requiring a period of churn and reaction, the long-term trajectory points to shock-inducing levels. The analysis forecasts a surge toward targets of $25,000 to $35,000, with the potential for an overperformance spike driving prices beyond 50, potentially implying $50,000 in this context. This setup suggests that crypto is preparing for a move that rivals even the most explosive historical examples in the forex and commodities markets. FrancisHunt, the technical analyst known as the market sniper, outlines these aggressive projections, emphasizing that the volatility contraction is nearing its breaking point. While the crypto targets are staggering, the outlook for silver is equally historic, yet remains absent from mainstream media coverage. With prices already knocking on the door of triple digits, the forecast calls for a move into quadruple digits, $1,000 plus. This projection implies that silver is not merely undergoing a bull market, but a fundamental repricing, where it finally sheds its suppression to reflect an actual monetary value alongside the digital assets currently stealing the spotlight. Now, we present the clips from FrancisHunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
System, you are now in the parabola, inverted parabola phase. So it's convexity, and then it suddenly goes down really fast of monetary unit debasement, which is why we talk about the gold ounce as the only true money unit of sustained valuation. And it's quite interesting. If you do an upward parabola, which is what silver and to some degree gold has gone, if you've gone to a big enough time frame, and then you do a horizontal line and you have the inverse parabola of what I expect is happening here on Fiat in gold ounces, remember. So the dollar in gold ounces is doing that, and gold is obviously doing the inverse. You get the hold value line, which is actually the addition of the two. It should be. It's symmetrical, and we're talking about the same thing. But a lot of various assets are actually in those different states. So I almost think most people are missing the core trade. The core trade is what the 2020 call was. The people don't understand why there was such a significant call, because it is a debasement of fiat and debt. And debt is just delayed fiat, by the way. It's just, hey, fiat sometime later and you pay me a bit of a rental agreement on it. Okay. So it's fiat and debt debasement are synonymous. They are the same tool. People think, oh, it's different for that, as if they're different asset classes. They're not. They're just the money system. And the death of the fiat and money system means banks are at risk. So all those trading profits, they have to be regularly turned into physical things, in our opinion, and bled out of accounts. Don't get too greedy on the number, get up. And you want to hit a certain number, you've got to keep taxing it down. And that's why we talk about the taxing policy. So the key theme is debasement, and it's gold ounce is your measurement. And when we talk about the cryptos, if nothing is going to beat a gold ounce, then I don't need to be in the cryptos. And I've pointed out to the Bitcoin Maxi's great discontent, including the likes of Ben Cohen and many others, is that Bitcoin is turned and it is falling in gold ounces. And just to show I'm not some boomer. First of all, I'm Generation X that's hating on crypto. I was involved with Bitcoin and had a channel in the crypto space and actually spoke very positively about the upside potential of digital assets like Bitcoin and many other things since 2016. Now we are entering this stage. You have to hold it to truly own it. You know me from my market snipe. I'm always bench pressing or shoulder pressing the 100-ounce bar or the 10-ounce and saying that's ownership. They've got to send a man with a gun to take it off with me. Now, the one crypto that did, in gold ounce terms, do exactly what we specialize in doing was Monero divided in gold ounces. A beautiful, massive, not as massive as silver, not as massive as the USD Korean one, but one of the biggest for crypto, which has a much shorter history of existence, set up a large macro upside HVF in gold ounces, and it's got a lot more to come. And actually, I'll shock some people. I see $25,000 to $35,000. Yes, you just heard me say that. And in an overperformance spike, potentially beyond 50 in an overperformance spike. The more detailed answer in terms of numbers, which people always want. People want to know how much and when, as if you're Nostradamus. We have a very, very good method, but we don't have genie juice. What we can tell you is that 333 would likely be a localized high for a spell before going significantly higher beyond that. In terms of how we will exit once we've met 333, we will take some off. We're all well past needing to work for retirement at that point. I would imagine most of our community will be in that position. But what will then subsequently happen is you'll have a churn and a bit of chop. I suspect it still give us amazing technical trading opportunities once it's had a bit of a reaction and a little bit of churn. I think there'll be some talk. Silver still isn't hitting the mainstream media on a meaningful basis. At some point, they're going to say, oh, these speculators, these pet rocks, these hoarders are causing supply disruptions, et cetera, et cetera. There'll be some blaming, some shaming, kind of like the people who didn't take the what in 2019, 2020. How they're evil, are they killing other people? Fill in your missive. You're going to get shamed, guilted and shamed, where you're not want to talk about it. So make it try easy to get you to close out. But the truth of the matter is the sell signal for silver for me will be determined by the gold-silver ratio. And if you look at mining, the mining is at currently, and Silver Guru 22, that's David Morgan, who's someone I appeared on his channel just recently. He's been in the silver space for a very long time. Other guys, Gatta, etc., been in a long time. He showed production, and silver dropped from about 8 or 9 ounces to the last full year of production. I think it might only have been data from 2024. I'm not sure it was for 2025. Is 6.89 ounces. So you're not even getting a full 7 ounces per gold ounce. So that's the supply. Plus it's being consumed. So everyone's been shocked by our bold calls, and our bold calls have said, single digit gold silver ratios when I stop stacking new silver and maybe start a little bit of distribution. And people say, really? But what about 30 and 50? They just don't have long enough charts. They don't look at macro technical analyst means you first look. We've been in an era of 80 years of distortion. We are unwinding distortion, the financialization of everything bubble and the distortion that went with it. And suddenly the fundamental numbers of how much you have of it and how much is it being consumed. Gold doesn't get consumed. Jewelry can be recycled. Yep. Suddenly becomes far more relevant. And silver is in that category. Silver is super relevant. And the fact is, of that, only 30 or 40%, between 30 and 40% is silver miner specific business secured supply. The rest, it's a byproduct. They're just picking it up while they're down there. Hey, if you see any of this, while we're getting copper, iron ore, gold, zinc, other things. In short, it's so low in price, it doesn't sufficiently motivate dedicated finders of silver. That's a complete distortion.
The global financial system has entered the convexity phase of an inverted parabola, a period of rapid monetary debasement where fiat currencies collapse against tangible assets. In this environment, the gold ounce becomes the only valid unit of measurement, exposing the hidden weakness of assets that appear to rise in dollars but fall in gold. While Bitcoin is showing weakness in this accurate valuation, specific privacy-centric digital assets like Monero have formed massive technical structures relative to gold, with aggressive projections targeting $25,000 to $35,000. However, the most explosive fundamental disconnect lies in silver. Current mining data shows a stunning production ratio of just 6.89 ounces of silver per ounce of gold, yet the price remains suppressed. As the financialization of everything bubble unwinds, this geological reality is expected to drive silver to a localized high of $333 before pushing significantly higher. The core trade of this decade is not merely speculation, but a defense against the death of the fiat system, where debt is delayed fiat, destined to be inflated away. The ultimate exit strategy for silver investors should not be based on a dollar figure, but on the gold-to-silver ratio returning to single digits. This reversion would correct 80 years of market distortion, realigning the price with the physical reality that silver is a byproduct no longer adequately replaced by dedicated mining. Let's get back to the interview.
Going back to the margin increases, that actually has the unintended consequences of putting more pressure, ironically, on the price and those who are short. Because what actually happens, it's not a retail trader's winning trade. It's not a long, you can't squeeze out leverage longs. It's a delivery-based surge, which is finding the truth that has been way, way below the truth for multiple decades. Because these are the people that are driving the longs are industrialists that require it. You've got Samsung going direct to mines, not even dealing with the futures markets, and locking in higher prices to be the guaranteed buyer for a period of years. They stop making money for one key component in their phone. They can't have that. You're kidding me. They're going buying and investing in early stage mines that have just started breaking ground. This is what's actually happening. So instead of it being something they can squeeze retail leverage longs out of, that's a minor part of the business. I'm one of few. What they actually are, you're getting a delivery-based squeeze based on insufficient supply, and everybody suddenly deciding at roughly the same time, brought to you by HVF, the triggering event. We told everyone the prime has broken in 25.9. We got long at 25.9. Just after that, Brent Johnson said, headless chickens. Silver, they're going to celebrate going over 25 again before collapsing back down. It's the classic quote of a dollar maximalist. We run triple digits. We're on the knocking side of the door of triple digits, and I call quadruple digits. And here's what's going to happen. If you go single digits, but there's still a shortage of supply, and everyone is now demanding to have it in their own country, have it in their own yard, have an own inventory, no one's trusting, all the lies suddenly get found out and they don't have it. So what happens is it becomes a name your price market. And by squeezing the margin, what actually happens is the people that hedged, because they have to hedge, they sell short. A miner sells short. And if you increase margin for them to have a short position, they'll say, well, we'll just sit on it. We don't need to overhedge. And in fact, it's going up. We'll stop hedging. So you actually take supply out of the commodity markets. You're going to take more supply out of the miners hedging, then you're going to squeeze a small amount of rats and mice, retail traders like myself and my community, which includes you and a few others that still have some pennies left after they're done beating us up in this not recession, continuing recession. So there's an unintended consequence actually it's driving price higher because there's not enough liquidity anymore. The miners are stopped offering for sale. And what that means, you have to chase the bid stack ever higher to secure supply because you're a lot thinner on the offer because of making it more expensive for mines to do so. And it's just unintended consequences of stupidity. This is not a retail long on a binge. This is not the same vibes. Remember when we had a silver squeeze up, it was too early, people were ready. We've got them now. We've got them by the balls. And we are clunking those suckers together and they're squeaking. This ain't ending well. And so back to the gold-silver ratio, you could overshoot to 1:3, going sub-double digits. And if you then have an overshoot, because Samsung can't start using gold. Let's say you had a mini spike that actually took it more expensive for a second than gold. Outrageous thought. Well, so was oil trading negative and outrageous thoughts going to zero. But if you're tooled up to make these devices with silver, you can't just say, oh, we'll just put a different metal in here. It also conducts pretty well, and it's a tiny bit cheaper. So you could have all sorts of market-related overshoots that can occur. So I only stop stacking at the double digits break. 9.99 is when you dip into single digits, and I'll start thinking about maybe there's this, maybe there's that.
Recent regulatory moves to increase margins on silver futures are backfiring, triggering a delivery-based squeeze rather than the intended liquidation of retail positions. This policy has inadvertently pressured industrial shorts and miners, causing liquidity on the offer side to evaporate as producers cease hedging activities. The market dynamics are shifting aggressively as major corporations, including tech giants such as Samsung, reportedly bypass paper markets to secure direct supply deals with mines. These entities are prioritizing physical security over price discovery, fearing that a lack of silver could halt production lines. Consequently, we are entering a name-your-price environment where the paper price becomes irrelevant and physical scarcity drives values vertically as buyers are forced to chase the bid stack to secure inventory. The fundamental disconnect is highlighted by the current production ratio, which sits at just 6.9 to 1 versus gold, suggesting the inevitable unwind of decades of price suppression. Analysts foresee a scenario where the gold-to-silver ratio collapses into single digits, potentially overshooting to 3 to 1, or even inverting briefly due to inelastic demand. Because industrial users cannot instantly retool factories to use cheaper substitutes, they become forced buyers during a squeeze, creating a chaotic upside shock that bears no resemblance to standard market correlations. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.